Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. Actually, it's been kind of quiet. I really liked what's been going on so far this year. Actually, the market made an all-time new high here not too long ago. Now, when I say that, I feel bad because I'm always knocking on these other guys for saying the same sort of thing. You go from 2018 to 2020, and market had a negative return over that time period, and then it just shot up, peaks in 2021 near the end of the year, and then goes down. In 2023, it made an all-time new high. Yeah, but it was still 20% below where it was 2 years ago. That's what really kind of gets me the most. And a lot of people look at their investments and they're listening to television, reading articles. Hey, the market made an all-time new, or made a new high for the year. You have to be very, very, very careful when you're reading an article, because the S&P made a new one-year high in 2022, 2023, and actually in 2021, and they were all within 2 to 3% of each other, and the market had gone volatile. It was very volatile, and it basically gone sideways. Hadn't made any money. And people will hear that all-time new high, and they look at their account and go, "Oh, this is not. I'm not making all-time new highs." Well, they do that to you on purpose. And I'm not kidding. Advertising is more effective if it's disruptive. If the stories are disruptive, then people have a tendency to pay closer attention. And you just can't. It's one of the reasons I have a job, is to go back and look at, okay, this is what we're looking to do. A big portion of your money is going to be in bonds, especially if you're not in your 40s. The older you get, the less volatility you want to get, hopefully. But in bonds, incidentally, are not without risk. They just don't fall as much as stocks do when stocks are going down. I think one of the biggest declines I saw was from 1920 all the way to 23, near the end of the year. That was the worst period in 40 or 50 years, and it was a lot. If you are reinvesting your dividends, the income from that, you probably only were down a couple percent or broke even. That's a long time to only be down a couple percent or breaking even for it, by the way. And that's looking at a fund that outperformed 90% of all bond funds. Okay. So that's one of the reasons I started looking at fixed indexed annuities, because they guarantee your principal and they guarantee a return. We'll come back to that topic later in today's show, but that was really the reason. I had a lot of people who are hardcore. Everybody has different beliefs about financial beliefs, money, politics, religion. Those are three topics you probably want to avoid if you can. Unfortunately, I'm involved in one of those for a living, so I have to talk about money. It's really difficult, by the way, to know that somebody has made an assumption that's wrong, and they really believe it. And the thing I like about finance, rather than you know religion or politics, is that sooner or later the numbers make sense. So if something has been overpriced for a long time, sooner or later it's coming back down. If something has been underpriced or has been going down for a long time and then it gets undervalued, sooner or later it's going to find its way back up to normal. And now that can take a really long time. There are different ways of reaching those goals. You've got different types of products to try to help you reach your goals, and everybody's goals are different. Incidentally, I've never seen two identical situations from families. In fact, it's rare that spouses agree on how they should be investing. More often than not, one of the spouses actually handles that for the couple, and the other one just goes on and doesn't really ask a whole lot of questions. It's pretty funny, and it's pretty evenly spread out. I know I used to hear, oh, the men handle all the money. That's probably true 20 years ago. But now, they pretty much joint, especially with the younger people. They like to sit down and hash out their goals. How much do you think you can spend? What do you think your dream life would be like now? And people I've talked to, been talking to each other, listening to each other, and so pretty positive. A lot different than 20 years ago. So anyway, not going to help you with that whole bond situation. Incidentally, most people were pretty shocked about how the bond market's been over the past 5 or 6 years. I mean, it's not been good, and it's highly unusual. And like I said, this has probably been one of the worst 5-year time periods in 40 or 50 years. Might even go back farther than that. I'll have to check that throughout the week and get back to you next weekend. But I know it's minimally the last 40 years. That's minimally. So in fact, I've never seen a market go from I don't know, a period of over 5 years where it's had a negative return. So I guess you say it's different this time. Yep, it's different this time. And, where are we there now? Bond prices, fixed income prices have a tendency to try to forecast what they think is going to happen. The money manager doing that. They're forecasting what they think is going to happen, and they don't actually wait for it to happen. They just start making the changes in the expectations, and that's where you can get some pretty quick reversals. They'll go up, in despite the fact that the news is still bad, because they're looking at a lot of stuff. I mean, I got a Bloomberg terminal that's really, really tough. I think I know who this caller is, by the way. His name is Tom, and I'm going to let him go ahead.
Hey, Bill, good morning.
Hey, how are you? I thought it was you.
Good. Yeah, good. I'm calling from California. I'm sunny Palm Springs. It's 8 a.m., 70 degrees today. Came out this weekend to visit my brother. But the reason I'm calling, I want to wish you a happy birthday today. And I want to wish you good health and happiness for many years. You've been a friend for well over 20 years, and I want to thank you for one of the reasons I'm so comfortable with my retirement was your help and guidance over the years. So I can't thank you enough. And I just want to remind you, June 1st is when I start my pool and bocce ball parties, and expect you over weekly. Yeah. And a lot of people don't know this, but Bill's our anchor. He always shoots fourth, and does a great job on our team to get us points. So I don't know if you've been practicing over the winter, but before you know it, it's bocce time, Bill, and we're looking forward to it.
Yeah, well, now I'm going to have to practice a lot to make good on that comment you just. So, well, hey, I hope you have a great time out there, and I really appreciate the birthday
Good.
thought.
Well,
And,
yep, have a great day, and keep up the great work. Good talking to you. Take care.
Thanks, you too. Yep. Bye-bye. That was Tom Basista. I don't know if you remember Basista Furniture out in, I think it's called Cleveland Furniture. It's right off of near 480 in Parma. You can Google it. And those guys, wow, that place goes back to, I think, the early 1900s, it's 1920 something. I'm pretty sure. I may be wrong. Probably am. But anyway, their father started, I think he started selling appliances there, and then they went from appliances to insurance that was in their names for decades. And very nice people. Their whole family, all the Basistas are nice. And, so anyway, now it's Cleveland Furniture, and a lot of the same people that worked there when they sold are actually, they still own the properties and stuff. When they released their properties to Cleveland Furniture, a lot of people that worked for them for years stayed. So must be going pretty good there. In fact, I have a lot of stuff from them at home. So anyway, I was talking about bonds, and it's really wild. The level of bonds, the price on the BND, that's the Vanguard Total Bond Market Exchange Traded Fund. It's one of those funds that are, it's a fund that's really difficult to beat. It's down 15% from where it was in 2013. Now, it's been paying income all those years. So if you were reinvesting it, you'd still have a return. But if you were spending the interest that they were distributing, then your principal would actually be down about 15% from where it was a little over 10 years ago. That's why you got to be careful. And I've had younger people that listen to the show. They've called in. I used to talk a whole lot more about individual stocks. I'm going to talk about that a little bit later in today's show. But they were getting kind of upset because I was giving time to this topic. I'm like, well, see, I don't think you understand. If you're young, great. You can be as aggressive as you want to be. If you've got 20 years or longer before you're going to retire, that's great. But you get up to within 10 years of retirement, you better, start reevaluating. What kind of risk are you actually taking? How much risk do you want to be taking? And I still don't hear a lot of rhetoric around that around the financial planning circles. I mean, it's like, here, fill out this questionnaire. And nobody knows what the questions they're asking most of the time. I mean, the professional probably does. But it's pretty confusing to people who don't do this all the time. And so they fill out these questionnaires, and they get these answers. Okay, this is what you should be. And that's fine. I've got a much simpler approach. Write all your money down, all your savings accounts, your IRAs, add them up, and then start subtracting percentages from it. And let's say it's $1 million, just to keep the math easy. And if you're down 10%, that's $100,000. Are you upset yet? You're probably not happy. But are you frightened? Because we know stocks are going to fluctuate a lot, and we know stocks are going to be a big portion of almost everybody's retirement plan. So, most people are going to have them, by the way, just to keep up their lifestyles in retirement. Why? Because they have a tendency to do better than other investments that you could make. Not always, and there are long time periods, like I said, where it's negative, and that's why you need to do this exercise. Write down all your cash, all your savings. Start subtracting percentages. How do you feel? If you're married, get your husband, get your wife, do it together. How do you feel? What do you think is realistically the number that you think you could withstand? Mine's 35%. So I've still got 70% of my money, which is actually lighter than it used to be, invested in stocks. If that were to drop, get cut in half, I know I'm going to be down around 35% or so, and I'm good with that. I just got the message. I got to take a real quick commercial break. This is Bill Bullington. I'm right here on 1420. We'll be back after these messages.
Resist the Drift Marriage Conference is coming to Genoa Church in Westerville, February 14th and 15th. Help you and your spouse feel more like soulmates again. Join Focus on the Family and AM 1420 The Answer by registering now at resistthedrift.com.
God is not done with America. God has a church that is more hungry and seeking His face than ever before. Come on down and witness a move of God at Strongsville Christian Church Pentecostal for our Holy Ghost and Fire services every Sunday at 11 a.m. and Sunday night at 6 p.m. God is pouring out His Spirit upon all flesh. This is Pastor Joseph Collini, and I am honored to hear ongoing testimonies of healing, signs, and wonders at the hands of Jesus. Strongsville Christian Church is a Pentecostal church that is located at 19132 Temple Drive in the beautiful city of Strongsville. For more information, visit us online at strongsvillechurch.com or visit us on Facebook, Strongsville Christian Church. Don't miss out on your breakthrough and blessings that is waiting for you at Strongsville Christian Church.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit joycefactorydirect.com.
Well, welcome back. This is Bill Bullington right here on 1420. I'm here every weekend from 11 to noon. If you'd like to call my office, you can go to my website, and the phone number is there. I'll also give it to you right now. It's 330-664-0700, 330-664-0700, or you can just go to my website, and quite frankly, I'd prefer that you call, just by the way, because the websites all over the country have been suffering from hackers, and I use the largest provider of financial services tools to financial advisors in the country, and they're getting hacked occasionally. So it's the reason I say that is I've gotten dumped a lot of notes people had sent from 2 or 3 weeks ago, and all of a sudden, now they're coming through, and it was because of all the stuff that they're doing, and there's a lot of mergers and acquisitions and that kind of stuff going on that has affected it as well. But the security protocols, they'd be very strict. So if something's going wrong, they don't ask questions. They just shut it down. And they can figure it out, get it fixed. It comes back up. Been horribly frustrating for people in my position. I mean, horribly. And they're not the only ones. There are tons of vendors, insurance companies, people that provide information for stocks. It's mind-boggling how far-reaching all that stuff is. So hopefully they'll get it. They've made a lot of progress in the past 6 months. There's still some bugs in it that pop up every once in a while, but they are responding quicker. It looks like they're getting a kind of a handle on being able to do all that. And the vendors that we use, the custodians that we use, are some of the biggest in the world and have some of the biggest IT budgets. So they spend a lot of money on that. And so that's been very helpful. It's difficult for an awful lot of people. I get it. Believe me, I am right behind you. I'm gonna be 62 here in actually, what am I talking about? My birthday's today. This is what happens. So anyway, by the way, the Boy Scouts were founded on February 8th. Yeah, it was in the early 1900s, but that's the only claim to fame I guess I can take with my birth date. So, but I'll take it. That's a nice organization. So, but anyway, back to investing. A lot of people are kind of nervous. I'll tell you this: valuations are better now than they were 3 years ago. Doesn't mean that stocks are underpriced. Okay, I still feel like they're a little bit on the high side, but nowhere near the extent that they were back in 2022. And it's only up. The big indexes are only up a little bit since 2022, and that's starting to shake some people because they're getting older. They, they're not remembering that we've had these conversations, and they definitely don't go back and listen to old shows. I wouldn't either, by the way. But it's a constant idea that I come back to, and it's not an idea really. They're just observations on how markets work, and I'm just pretty surprised that most people still at this point in time, and they get young people call, and they're making the same mistakes their parents made, only faster, because you can do so much more, so much quicker on the internet today, and the internet itself moves at an amazing speed. But just because you can move really fast doesn't mean that you should. Ask a race car driver if you should drive around the city at 200 miles an hour or over 100 miles an hour because you can. It's not generally a good idea, and market's very similar in that respect. There are lots and lots and lots of things you could do, but should you? It really depends on your personality. And as you start getting older, you start getting closer to retirement age. Okay, you really need to take into account, what would happen if you had a big correction in the stock market and you had most of your money in there. Would you be able to cut back? Would you need to cut back? That depends on your exposure. I would not know that unless I was actually looking at I didn't look at your accounts, and I've done this for so long that within less than a couple minutes, I can tell you what kind of risk, where your portfolios would have peaked out, where they would have bottomed out in the last big correction, last 2 or 3 big corrections that we've had, and how much approximately you could take out of that portfolio without increasing the risk of running out of money significantly. And so a lot to be said for experience, by the way. There's also a lot to be said for technology. We use this service from Morningstar. It's really expensive. And they were going through upgrades. And, it just dawned on me the last few days. They knew that these problems were coming, and they didn't warn us. They had problems with it. It was not smooth. And they didn't warn the people that were using it. I'm a long-time subscriber, and it's very expensive. If you want to see your portfolio, what it would have done over the past 10 years, even to inception of the funds that you have, we can actually do that sort of thing. We use it for building models. They bought the company called Ibbotson, who basically is kind of the father of modern statistics on financial markets. and I've been using it for a long time, but they didn't tell us, and I'm sure they didn't because they didn't want to have to go through the aggravation of people canceling their accounts and then having to reinstate them. So, but I, hopefully they're not going to be making those major changes like that anymore. I don't think they will. I think they get it mostly out of the way at this point. It'll just be tweaking it. But talk about frustrating. Holy cow! And in fact, I'm just looking at something that I printed out from there. You could get statistics on anything or any ETFs, any stocks, any mutual funds. If it's not in there, it probably doesn't exist. Um, and that's basically how comprehensive that database is. And I was just looking at mid-cap, the difference between the growth and the value. And over the past, let's see, what time period was this? Okay, 10 years. So over the past 10 years, there's a big difference. The growth-oriented funds came in at it was almost 50% higher, about 40% higher than the value-oriented ones. The blend that has both growth and value in it came in a little less than looks like it's 21% higher for the growth over that period, and very similar when you look at large companies and when you look at small cap. That was just mid-cap indexes. So what can I glean from that? Well, when I went back and looked at the guidelines, basically the formulas for how they're selecting the stocks. Remember, these are all done with math. They're not done with emotions. Nobody's picking the stocks. I think there's a place for that. But if you're looking at traditional indexing, which we use a lot of, most of the funds that we use are index funds. And in fact, all of them are. There's an index that I like better than these. We'll talk about it a little bit later. But I've been using it now and trying to put it in place as quickly as I can. My clients' accounts, I think it's perfect. As far as stock ideas or structures for how you're going to run your fund could be, and it takes into account the company's size, speed, and profitability, and the way that it's calculated, I think, is really good, and it's very close, to the growth-oriented ETFs out there. And one of the things that it's kind of upsetting in my industry is that they've got these models. That Morningstar actually bought the company Ibbotson, and Ibbotson has basically had a huge impact and has huge influence over our entire industry. And some of the stuff that they're using, it's just wrong in my opinion. It's cost an awful lot of people, me included, a ton of money following their instructions, saying, "Well, this is how it should be." Okay, yeah, but in the real world, they don't care how you think it should be. This is how it is. And it's one of the reasons the S&P 500 does so well relative to almost everything else. And when you take a look at the other indexes that have done better than the S&P 500, they have these characteristics in common. Now, can you say absolutely positively that those characteristics have led to the outperformance? No, you can't. And it could potentially change at some point in time. But personally, I doubt it. I don't think that's going to happen. And at some point in time, we'll probably have these. They'll do further research and say, "Oh, yeah, I don't know. It's very frustrating that people in my industry are so stubborn and so slow to move and slow to adopt or adapt to new environments. Eventually, they do. but it can take forever. And by the way, they're the ones that are writing the rules. It's unbelievable the amount of regulations we have, and so that's one of the things I keep hoping might change at some point in time. I doubt it though, but to keep it all simple, try to. I use it. One of the other reasons I use exchange traded funds, other than being able to know exactly what I have. I know exactly what is in the funds, how they're selected. That's a big deal because 95% of successful investing is psychological. It's in your head, in other words. It's not panicking when everybody else is. That's 95% of your performance is going to be because you thought about it and you didn't panic, assuming you have good performance. And actually, 95% of your performance, if your performance isn't that good, is because you panicked or you were looking at something. And this is what always, well, not always, but occasionally happens. The people will look back into the past and say, I don't think I did that well. Well, you did the best at the time given the amount of risk that you wanted to take. If you go back and you look at your paperwork, if you've been with an advisor, again, 19 out of 20 times when somebody is not happy, it's because the advisor wasn't able to get through, or you forget. I said, I'm only comfortable being down by 35%. Okay, so you're only going to have about 60%, 60 to 70% of the money invested in stock funds. That means you got 30 or 40% of your money invested in fixed income, which are bond funds. That doesn't pay as much. Yeah, it doesn't pay nearly as much. So when you're going to do a comparison, you should keep that in mind. This is how much risk you wanted to take. Here's the model that if you could invest exactly the way that you'd like to, here's how much it would make. Now, if you're behind that by a lot, and then you might want to make a change or start talking about making changes. So anyway, I went through all this stuff mainly because in my industry that is our biggest challenge. Somebody tells you, well, or they restrict you because if somebody says, look, I don't want to be down more than 30%. You better not have them more than 60% in stocks. Better not. We get audited. Like, I get audited every year. I think it's just because the guy likes it from the Department of Security. But we try really hard. I'm always asking him more questions than he's asking me, and it's pretty cool. We have a good relationship. They're tough. They're always saying, "Hey, okay, you did that. You got to do this," and oh, okay. At this point in time, it's not nearly as difficult. But anyway, long story short, they're there to put in guidelines to help you out. It looks so easy. That's another thing. Everything looks easy, especially when the market's going really, really well. But like I said, there are certain algorithms. Those are just formulas that you look over time. And when you look at the value category, the growth category, and the blend category, the growth and the blend have been, at least over the past 20 years, the growth and the blend categories have done much better than the value-oriented ones. And and a lot of people say, well, the value is probably a lot less risky, right? Not really. When you look at the total volatility of all the funds, and they've got a whole bunch of numbers and a whole bunch of ways of measuring the volatility, they're really close. So if they're going to be really close, wouldn't you rather just have the ones that are doing better? Yeah. If you're going to have to take about the same amount of risk, I mean, it's common sense. But I'm telling you, because I've had to do this myself, this is not something that I was having, that I was even getting any help in when I worked in the brokerage industry, same one that almost everybody else works in, and I understand why those guys are not doing this. And that's why I left. They really can't afford to spend that kind of time on the education of their advisors. And I'm not naming any names. And there are a lot of good advisors, just like myself, who take the time to learn and go beyond and spend that extra money for the research that's been done out there by financial professionals with PhDs behind their names. And I really like it, so it's easy for me. But anyway, I've only got about 50 seconds here before I have to take a commercial break. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you wanted to talk about your own situation, no problem. Just go to my website, bullingtoncapital.com, or call us 330-664-0700. And I'm going to take a real quick commercial break, and I will be right back.
Yeah, I don't always feel it. Yeah, but that's when I need it the most.
Anyone can choose to make a difference. You can earn money for college, learn career skills, and make friendships that last a lifetime. Make a difference. Choose your future. Choose AmeriCorps.
We had water seeping up the drain in the basement, and that's always alarming. We had kind of a Band-Aid job done, but we weren't going to go back to them.
And she says, why don't we call Wyatt Works? And I was like, oh, yeah, that's those whistling plumbers.
They are men of a higher caliber. Definitely.
Yeah, we had the pipelining. I was very impressed with that technology. I have peace of mind. I have comfort and assurance now that I never have to worry about the drain.
Everything was top-notch, professional, but friendly and personal.
I was grateful that the liner job was not only cheaper than doing a dig out, but I was really grateful that I didn't have to have all of my concrete tore up and then have a concrete job on top of everything.
I think Wallackadoodle means we did it, it's done, you don't have to worry about it. Amen, hallelujah.
Consider it done at WyattWorks.com.
Wallackadoodle.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program after 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owners sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO, Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org. Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
Well, welcome back. This is Bill Bullington. I am here every Saturday morning from 11 to noon. If you'd like to reach out to us, the website is bullingtoncapital.com. There's a contact us page there. You can sign up for newsletter. We send these out typically 2 to 3 times a month. They're emails. And basically, I have a service that recommends various stories that they think my client base might like based on a questionnaire I filled out. And I just pick the ones that I like and send those on out. And in fact, one of them, one of the reasons I was talking about all the other things I was talking about on this show is was from Barron's and was written by a writer named Neil Templin. And the headline is a tried and true tactic to stay invested, even in tumultuous times. And he talks a lot about dollar cost averaging, which is something that you've probably heard of before, maybe multiple times. But it was a, let's see here, dollar cost averaging is kind of old out there. And when you get up into your 50s, you've probably got a fairly significant amount of money in your 401k plan anyway. It's not going to add that much from a financial standpoint. It's still important to rebalance your portfolios, make sure that you're looking at the amount of stock versus bonds versus cash that you have. Is that today, is that still in line with your risk tolerance or your fluctuation tolerance, I call it. Anyway, so and it just goes on to give a lot of really good information that would be expensive to be able to get on your own. So that's one of the reasons that I really like it. And it was interesting. They had they're talking about NVIDIA, and that's been in one of the, you've heard me talk about semiconductors over the years. Well, that was one of the reasons. NVIDIA is in a couple of the ETFs that I hold. Yeah, I stopped using an individual stock model for this, even though it's done, that old model is done very well, but so have the ETFs, and they are a lot more tax efficient, like by far. The difference in taxes between having an individual stock portfolio, especially in a sector like technology, and also semiconductors, because they're incredibly volatile. But in a fund, that kind of mutes some of the volatility. And instead of holding individual stocks, not having to see that NVIDIA shares on last Monday, dropped 17%, which is not uncommon, especially for a tech stock and any stock that's traded on a major exchange in this country. They can move up or down like that, no sweat. And the average range annually on on a stock that trades on the New York Stock Exchange, it's around 50%. That's a lot. And those are even the good ones. That will fluctuate like that. I know for sure. I've been doing this for a really long time. So that's one of the reasons that the diversification thing is kind of a really big deal. And if you want to put the pedal to the metal, the best way to do that is probably to overweight a little bit on the growth side. When you look at the calculations of how they're selecting those stocks, it's not hard to see why the last 10 years growth has outperformed the other categories. Okay? Now, will that go on forever? No, because nothing does. But every few years or so, it might have underperformed the other categories for a little while. They'll have their day in the sun, and then it goes back to it, or at least it has in the past. Unless you're Japan, that's a whole other conversation. But anyway, diversified. You want to lean towards growth-oriented products, and I guess this is one of the things that can be a little bit frustrating for an advisor. The general public thinks that all you have to do is look up the best performers and you're done. That if that were it, every librarian would that studies history or history major would sooner or later figure out to go look at stocks, and they would be billionaires and they'd be everywhere. There's a little bit more to it than that, and that little bit's a lot. It can be very meaningful, and one of the jobs of your advisors is really, when you get nervous, answer your calls, talk to you about it. Let's go over and review. How much risk were you really willing to take, and are you still within those guidelines? I think the number one problem I see is that people they want to be really conservative, but then again, when the market goes up 30%, they want to be up 32 or 28. They want to be close to whatever the market's doing, but they don't have the risk tolerance for that, and they forget. So that's one of the reasons I have a job too. Well, here's your questionnaire. You said that you probably wanted to stay within a 30% decline, and to match the returns of the stock market, you're probably going to have a 50% decline tolerance, because it's been down 50% multiple times in my lifetime, and I'm not 100 yet. Not yet. So I hope I don't make it that far. But the bottom line is, within every 20-year time period, there's been at least one major league decline, and we've had a couple of them over the past couple decades. So I don't think we're due for it, but you never know. I mean, it can come at any time. That's one of the reasons that annuities are so popular, and I get it. I never thought I'd have as much money as I do in fixed annuities, but as I started getting older and the more knowledge I gained and the more experience I gained, I'm like, yeah, now I see why they're doing that. So the actuaries were probably my age that were putting this stuff together. My age now when they were putting it together. But yeah, there are options out there. There are more good options now than there have been in quite a while. It was really tough when interest rates were down around zero. That was or less than 1%. That was brutal. Hopefully we don't see that again. By the way, the reason that interest rates do go up is because inflation gets to a point where they say, okay, we have to do something about this. We have to start raising interest rates. If we let inflation get too out of control, that's not a good thing. When your money's purchasing less and less and less, and when you're retired, you notice a lot more what you're spending at the grocery store. Probably because you don't have as much to do as you did when you were working. But a lot of people get really shocked by that when they see the annual increases in prices on food, and it's pretty volatile. But it's like stairs, or actually it's like any other graph. There's ups and downs, but the highs keep getting higher and the lows keep getting higher. So in the long run, it's there's going to be inflation. That's one of the reasons you're going to have some of your money in managed stock accounts. Hopefully, that's doing well. You will do better if you understand how it's being invested. And I know my clients, when I talk to them about it, they forget. So me calling them, I'll reach out. Hey, do you need anything? Is there anything you'd like to talk about? and most of it's through an email, but we'll set up a meeting in person or over the phone, whatever is most comfortable. That's the key. Trying to knowing that investing is uncomfortable. You don't want to aggravate that situation. You want to try to make it as comfortable as possible. So however you're working with an advisor, if you do, let's ask him, what can I do to make this more comfortable? And he's going to ask you, well, I don't know. What do you think? Would it help if you came in? Would it help if I met you for lunch and we would go over it together? That kind of thing. So, but if they don't know, if you're not saying anything, that's not good. You need to, if you feel like you need some help, reach out. And I'm saying this as much to my clients as I am to the general public. If you feel like there's something that you'd like to talk about, reach out to me. I get a lot of calls, but I'll get back to you. And it might take me a day or two sometimes, because now we're bigger than we used to be. But I will get back to you. And I'm a big believer in the United States. I've only got about 60 seconds here before the show is over. But I'm a huge believer in the United States, especially with the Federal Reserve System that we have. So when we come back next week, we'll talk about that, how the Fed makes it nearly impossible to fail on a financial basis. Not that it's, doesn't have its downsides, but if you know what those are and you can prepare for them, that's a big deal. So anyway, this is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. My website's bullingtoncapital.com. Sorry about that. I blinked out for a second. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.